Good morning, everyone. A very warm welcome to the webinar on Interim Budget 2024, clause by clause analysis of tax impact, organized by VILGST and Tax Connect. Now, I would like to introduce our speaker, Mr. Vivek Jalan. Mr. Vivek Jalan is a qualified chartered accountant, qualified LLM, and LLB. He is the chairperson of the Fiscal Affairs Committee of BCC and I. He is the regular speaker of various professional forums on the key areas of direct and indirect taxes. During the session, please put your video and microphone off. If anyone has any query, please write in the chat box. We will answer all your queries at the end of the session. Now, I request Sami sir to say few words. Over to you, Sami sir.
Thank you, Tatli. Good morning to all the participants. Good morning, Vivek.
Morning, Samir. Morning.
Welcome to this session. Although it was an interim budget, but it saw a few changes which will have a great impact on the businesses. So this, as far as the tax changes are concerned, there are not too many. But that one significant change that we'll go through today, request Vivek to take us through whatever the impact that's going to have and how the businesses are going to deal with it. And overall, we'll have maybe a more elaborate session once the full budget comes in the month of July, maybe. So over to you, Vivek, to take hand over this session to you.
Thank you, Samir. Am I audible?
Yes, yes.
Just put on my. I'll just share my screen. Quickly, is the screen visible?
No, sir.
Sorry?
Starting to share, sir.
Yes, sir. Yes, yes, sir.
Okay. So, good morning to all the participants.
Vivek,
Morning.
Vivek, I can't see your screen.
The PPT is not visible?
No, I don't see
Sir,
it.
it is visible, sir.
Not to me. Maybe you.
Yes, sir. Now it's visible.
Yes, sir.
Now it's visible.
Yes, sir.
Samir?
No, it's not. I can't see.
Participants are saying it's visible. Maybe in your screen, it will take in some time. It will come.
Maybe you could start now.
Yeah.
Yeah.
So thank you to all the participants for joining this webinar on a working day and so early in the morning. As Samir said, that since this was an interim budget, and I remember in December itself, the Honorable Finance Minister had clarified in one of the conferences that not to expect any major big bang changes in this interim budget. And that is how it came out. But still, there are few important announcements in this budget which lead to implications going forward. In fact, generally people think that in GST the budget is not for GST, but there are changes in the GST Act which would have implications on the businesses. So we'll discuss the amendments in income tax, in GST, and also the critical two important things which would impact the businesses you see one in income tax, this 43BH, which is a very, very important change for businesses and where business has to start complying from February itself. So from now, and this would impact the balance sheets if not complied till 31st of March. So that we'll discuss. And one very important GST, I would say, development on the interest applicability of GST, which would again impact the businesses. So all of this we intend to discuss over, the next 1 hour or so. In case you have any questions, since it's a live webinar, so you can always ask all your questions on the chat box. We'll try to answer all of them at the end of the session in the last 15 minutes or so. So, friends, as the Honorable Finance Minister in Part B of her budget speech also said, and the memorandum on the finance bill also clarifies the object that the object of the finance bill was not to make any changes in the income tax rate, but to give effect to certain financial proposals of the central government. So what are the financial proposals in a budget? We did not see a budget at a glance. The budget at a glance generally is the balance sheet of the government, or you can say profit and loss account of the government, which shows the incomes of the government or the receipts of the government during the year and the expenditures of the government. Difference between receipt of the government minus expenditure of the government is the fiscal deficit. Fiscal deficit number divided by the gross domestic product of the country, that gives the fiscal deficit percentage, which we saw the finance minister has announced. The fiscal deficit percentage for this year is 5.1% of the GDP for 2024-25. So this, what is this 5.1%? This tantamounts to around 16 lakh crore rupees of loan, which the government has budgeted to take during the year to propel the growth. It was 5.9% budgeted in 23-24, and the final revised estimate has shown 5.8%, which means that the government is spending judiciously. Mind that this 5.8% is after spending 10 lakh crore rupees for capital expenditure. Also, this 5.1% fiscal deficit, which is quite a gliding number from the corona period, that is after spending 11 lakh and 10,000 crores towards capital expenditure, which is quite a big number considering it is 3.4% of the GDP of the country. So these are the revenue collection estimates, which you can see on your screen over the next year. So income tax as well as GST, both the estimated collections or the budgeted collections vis-a-vis the revised estimates of 23-24 is a growth of 13.1% approximately for both income tax as well as GST, right? Income tax includes corporate tax as well as personal income tax. So, which 13% year-on-year growth, considering 5% inflation and 7% is the GDP growth, which means already the government has budgeted for a buoyancy of 1%, as against 12% of inflation plus GDP, 5 plus 7, the government has budgeted a growth of 13%, which means a 1% buoyancy, which is a very good buoyancy. Which also means for the taxpayers, all of you over here are taxpayers. It means that with the GST 18-19 becoming time barred on 30th April, the extended time bar period for 18-19, 19-20 assessments in GST becoming time barred on in August 2024, and the show cause period for 1920 getting time barred on 31st May 24 itself. So you could see a lot of more notices under GST and a lot of more demands getting generated under GST if the government has to do this kind of 13% of growth over the revised estimates of the last year. So this is the macroeconomic scenario. I will not go into the sector-wise analysis which the finance minister has said in a speech. I would go directly to the income tax changes. And the most talked about income tax amendment, so to say, was the withdrawal scheme. First of all, and very important for all the participants to understand here, is that it is not an amnesty scheme or a waiver scheme, right? So let us be very clear, this is not a settlement of dispute scheme, amnesty scheme or waiver scheme, right? Therefore, it has not found a place in the Finance Bill 2024. If you see the Finance Bill, this withdrawal scheme is not there, which means that it is an adjustment in the books of the central government. What is this adjustment? Now, in 2010, the government has moved from the charge-wise litigations in or notices issuance in income tax to CPC, Bangalore, right? So now everything is handled by CPC. It is the IT arm of the income tax department. Even the 143(1) intimations, etc., are through CPC. So in 2010, the government has moved to CPC. What happened, as it always happens in every such transition, is that there were many demands which were raised on the taxpayers, which the taxpayer had already settled or already had paid. In fact, I myself had a 20,000 rupees or so demand. So what happened? The taxpayer had already settled that demand. But while transition to the CPC, this demand got carried to the CPC. And as you know, the demands gets automatically adjusted against the future refunds under section 245. Now, some people like me, in my case, we did not dispute the demand. We just paid off the demand because it was a small demand. Why to dispute? So that demand got settled. However, some people or most people, around 1 crore taxpayers, they disputed this demand. So when you get a 245 adjustment towards your refund, you get an option online on the income tax portal, we all know, to refute or to reject and accept the demand, right? So like this, there were more than 1 crore taxpayers with less than 25,000 rupees of demand, which got adjusted but were disputed by the taxpayers online for adjustment towards their refund. Mind that very important again is this 25,000 rupees till the period 2009-10. This is inclusive of tax, interest, penalty, etc. It is not merely a tax component. And that is why I have said in the very beginning, it is not a settlement of dispute or amnesty scheme, right? Thereafter also till 2014-15, that is from 10-11 to 14-15, there are petty demands, sometimes 1 rupee, 2 rupee, 5 rupees, 1,000 rupees demand. These kind of petty demands has accumulated over the next 5 years also. These are standing as receivable in the books of the government, but there is actually no demand
Sir, your voice is breaking.
been settled by the hello. Just uh, now it's fine.
Yes, sir.
Hmm?
Yes, sir.
Okay. Yeah. So these demands were appearing or are appearing in the books of the central government income tax department, but actually there is no demand. The government just wishes to write off these demands, which are actually not demands. You can say they are non-existent demands. So the government wants to clean its books of accounts and therefore withdraw such claims or withdraw the adjustment against such demands or the claims towards the taxpayers. And therefore they have come out with this withdrawal scheme, right? The question is, what needs to be done by the taxpayers? As per our understanding, there is no requirement of anything to be done by the taxpayers until and unless there is some utility on the income tax portal to act, right? The government would withdraw such demands automatically. The refunds which were earlier blocked, they would be settled. So you would get your refunds in case you have such a demand outstanding against which taxpayers have
Sir, your voice is not
taking.
clear.
Yeah, in the location. Hello, is it clear now?
Yes, sir.
Yeah, Vivek.
Yeah, yeah. So uh, the question now in this withdrawal scheme is, what happens to persons like me, for example, who have actually not disputed these demands but paid off these demands, right? In such cases, friends, as per my understanding goes, nothing needs can be done now. If you have paid off, you have paid off the demands. There would not be any withdrawal of the demands which you have already paid off, as far as uh, my legal submission goes in this matter, right? So this is this withdrawal scheme which have has made a lot of noise over the last day or so. Another, if you see the finance bill, another one page amendment is with respect to section 206C 1G. What is 206C 1G? It is a TCS on foreign remittance or overseas store program package. This TCS had been implemented around 2 to 3 years back. At that time, it was 5% on the overseas tour package. So a TCS was collected when you were going or paying for the overseas tour package to a tour operator or a bank. In the last budget, with effect from 1st of July 2023, the Finance Act provided that the scheme of 206C1G that would undergo a change. However, there was a press release on 28th of June. Thereafter, there was a circular number 10 of 2023, which deferred the implementation of the Finance Act 2023 to 1st of October 2023, which meant that from 1st of July 2023 to 30th of September 2023, this press release or circular that was in effect, but consequential changes were not made in the act, this section 206C1G. So for July, August, September 23, the scheme was deferred. Lower rate of TCS or higher rate in cases that was collected during these 3 months without a consequential amendment in the law, in the statute itself. So that amendment for the period July, August, September 23, that has now been made by Finance Bill 2024 with retrospective effect from 1st July or 1st October 2024. So there is nothing which impacts today from 1st October 2023 till now. The new rate of TCS under 206C1G that is already implemented and that is already applicable. So what are the new rates and old rates? The old rates which would be applicable till 30th of September 2023 are as follows. It can be divided into two categories. First category is overseas tour operator, where the earlier rate was 5% from rupee 1 and it was 5% flat. In all other three categories, that is, number one, if you are taking a loan and making a remittance of that loan for education purposes, number two for medical and education purposes, and number three for all other purposes. So if you're taking a loan and remitting it for educational purposes till 7 lakh rupees, it was exempt. Over 7 lakh rupees, it was 5%. That remains the same after 1st October 2023 also. For remittances for medical and education purposes, till 7 lakh rupees, it was exempt earlier also, and over 7 lakh rupees, it was 5% in the earlier regime, in the earlier period also. That remains. There's only one change with other than tour operator remittances, that is for all other remittances other than medical and education purposes. Earlier till 7 lakh it was exempt. Now also it remains exempt, but earlier over 7 lakh rupees of remittances, the TCS was 5%. Now for over 7 lakh rupees remittances in a year per person, that is 20%. So 20% TCS is applicable. For tour operators, it was 5% from rupee 1. Even now it is 5% from rupee 1 till 7 lakh rupees. Over 7 lakh rupees, any remittance for overseas tour package, that is 20%, right? So, this is already applicable from 1st of October 2023. This amendment in the finance bill that has been made only to give effect of for the period July, August, September 2023. free. Thereafter, in income tax, there are few extensions, but an important provision which has not been extended. We have tried to pursue it with the CBDT, but finally it was not to be. That is the provision of lower rate of 15% income tax under section 115 capital BAB for newly manufacturing setups, right? So in case a newly manufacturing setup is starting operations, that is starting the manufacturing till 31st of March 2024, the income tax rate under 115 BAB, subject to the conditions mentioned thereunder, would be 15%. But if the manufacturing operations would start after 31st of March 2024, then the rate of income tax would not be this concessional 15% rate. It would be the higher rate of 22-25%, whichever is applicable. So this is one big provision which has seen sunset on 31st of March 2024. However, they have extended for 1 year the relaxation for startups under section 80 IAC. As you know, for startups which are registered under DPIIT, they would get an income tax exemption for 3 years out of the first 10 years of operations. That has been extended for all startups which are incorporated for the financial year 24-25 also. Section 10(4)(d) with respect to specified funds and offshore banking unit, that has been extended for 1 more year. Exemption on royalty or interest income received by a non-resident for leasing of ships, vessels, etc. that has been extended till 31st of March 2025, that is 1 more year. Similarly, under section 80 LA, the exemption for the benefit of 80 LA for transfer of an asset being a aircraft or a ship, that has also been extended for 1 more year. The exemption for dividend interest, long-term capital gains of Dubai Investment Authority or sovereign wealth fund or pension fund, whatever they receive in India, that exemption has been extended till 31st of March 2025 for the investments made till 31st of March 2025. Faceless assessments have now started settling down in income tax. Faceless appeals to some extent have started settling down in income tax. Now they want faceless ITAT, faceless income tax appellate tribunal hearings also. The infrastructure and the procedures that need to be amended as far as tribunals are concerned. So that implementation has been deferred for 1 more year. Also, dispute resolution panel related faceless scheme, as well as faceless scheme under 92 CA for determination of arm's length price, that also has been deferred by 1 more year till 31st of March 2025. So by and large, friends, these were the amendments in for income tax in the interim budget 2024 in the finance bill 2024. Now we'll go on to GST amendments. While this is nothing new, this was already decided by the 50th GST Council as well as reiterated by the 52nd GST Council minutes. But the amendment to the CGST law, happens only once in a year during the Budget and White Finance Act. And therefore, that has been also proposed for amendment in the CGST Act by the Finance Bill 2024. This is related to the mandatory implementation of ISD provisions. So, all multi-state registered taxpayers who had the option of either going through the ISD route or cross-charging earlier, they would now be mandatorily liable to distribute the common ITC only through ISD mechanism, right? There are two kinds of common services which the head office takes. One is the common services taken from third parties. For example, Pan India advertisement services of a multi-state registered enterprise, or auditors, statutory auditors fees for a multi-state registered enterprise. Say, for example, I am registered in Maharashtra, Haryana, Karnataka, and West Bengal, right? The statutory auditor raises a bill. He renders the services to all four registrations, right? So that is a common service for all four registrations. Earlier, there was a mechanism of cross-charging, which was even advocated in the FAQ issued by the CBIC related to banking and financial institutions. There it was advocated that either you can distribute this through ISD mechanism, or the HO, say the HO is in Maharashtra in my example, that could cross charge it to the other locations after taking the ITC eligible for it. Second type of common services are internally generated services. That is the services of, say, for example, director or CFO of multi-state registered organization who is providing services to all the GSTINs. There was a dispute that what to do. Should we cross charge, since the director or the CFO is rendering services to all four locations, all four states in my example? Should we cross charge the CFO services or should we not? After the 50th GST Council's recommendations, it was held that whatever has happened in the past has happened, cross charge or ISD, all of that will be accepted. Even no cross charge, no ISD would be accepted. Prospectively, after ISD provisions are notified, thereafter only it has to be routed through ISD. Now, the question was, what about internally generated services like CFO services in my example? So, Circular 199 has made it very clear. It is dependent upon the taxpayer. If you want to cross-charge such common services which are without GST, you can cross-charge. If you don't want to cross-charge, you don't cross-charge. No action will be taken in this regard. This was a big dispute, and various judgments were there with respect to cross charge in service tax as well as in GST. In GST, the famous judgment of Columbia Asia was there. Now that cross charge thing for internally generated services had been put to rest. With respect to ISD, for implementation of the 50th and 52nd GST Council recommendations, now section 2 subsection 61 and section 20 has been amended. Now there is one confusion over here which we'll dwell upon as we discuss 2 section 61. Before that, as of now, what are you doing for the, say for example, royalty payment which you are doing to your foreign mother company? Royalty, so import of services are under reverse charge. Royalty is paid for all 4 branches of the state in the states. In my example, in my company, in my example, so you pay it under reverse charge from your HO registration, and thereafter, as per Rule 54, Sub Rule 1, capital A, you make an invoice from your HO normal registration to ISD registration. Thereafter, from ISD registration, you distribute the ITC, common ITC, right? Now, under 2 subsection 61, the definition of input service distributor has been amended. It says that input service distributor is an office of the supplier of goods or services which receives tax invoices. Here is the big change, including invoices in respect of services liable to tax under 9(3) or 9(4) for on behalf of distinct persons referred to in section 25 and liable to distribute the input tax credit in respect of such invoices in a manner provided in section 20. So number 1, this word liable highlighted on your screen, it makes it mandatory for the input service distributor registration to be taken. Number 2, it makes it clear that RCM invoices can also be made on ISD registration, right? But now let us go to section 20. The entire section 20 has been overhauled. We have already sent the PPT. You can watch the background material and the old and the new section at your pace. But what are the major changes? So I would draw your attention to section 20, subsection 2, which says that the input service distributor may distribute the credit subject to the following condition. A document needs to be, this is the old section. Yeah, this on your screen is the new section. So 20 subsection 2 on your screen, it says that the input service distributor shall distribute the credit of central or integrated tax charged on invoices received by him. No problem here. Including the credit of central or integrated tax in respect of services subject to levy of tax under 9(3) or 9(4). So till here it says that the input service distributor shall be liable even to distribute common ITC with respect to GST paid on RCM basis. No problem. But on your screen in bold, if you see 20 subsection 2, paid by a distinct person registered in the same state as the said input service distributor. So here, to my understanding, this 20 subsection 2 is conflicting with 2 subsection 61. 20 subsection 2 says that the RCM needs to be paid by the normal registration of the taxpayer only, but it needs to be distributed through ISD registration if it is common in nature. However, 2 subsection 61, if we read, it seems that the ISD can receive the RCM bills, pay the RCM on reverse charge and distribute the ITC. So this needs to be further clarified. Also, Rule 39 would be amended going forward. And once Rule 39 is amended, more clarity would come on this. As of now, also, wide Rule 54(1)(a), this mechanism does prevail that RCM invoices are paid by the normal GSTIN of the HO state. Thereafter, it is routed and distributed through ISD. However, if they want to make this change that ISD can pay common RCM services and then distribute it, then there is an amendment in the GST network and the GST portal which would be required, right? And other things remains the same. The central tax can be distributed as central or integrated. State tax can be distributed as state or integrated, and integrated tax can be distributed as all three. Right? So this is Rule 54(1)(a) for you. Now, friends, what are the business implications? First of all the earlier notices, and I am sure many of the taxpayers would have got notices, and I myself dealing with so many notices in every state where common ITC was not distributed through ISD, was cross-charged, was not cross-charged in the earlier period. All these notices would be put to rest. In fact, in one of the states, there was a mere error of reporting ISD ITC in all other ITC rather than ISD ITC in GSTR 3B, and today we are standing with a demand in that state, right, for such a small procedural lapse. Now, through Circular 199, it is clear that in earlier periods, it would not impact even in case the common ITC was cross-charged. But prospectively, once these provisions are notified, you all know in GST, to notify any provision, just a second. Sorry? Coming now. Yeah. So, ISD mechanism, once these provisions are notified, ISD, just a second. Yeah, there was a technical glitch. So for prospectively, once these provisions are notified in GST, you know that these provisions of ISD 2 subsection 61 or 20 would be notified only after it is passed by more than 50% of the state legislatures. So once these provisions are notified, thereafter you cannot cross-charge any common ITC. Clear? But for internally generated services, like I said, CFO services, there is an option. You may or may not cross-charge. You don't cross-charge, no problem also. However, friends, this is important. It is in bold on your screen. Many of the times, just to transfer the ITC from one state to another state, cross-charge mechanism is used. That is a offense under GST, because it would be considered as a raising of an invoice without underlying services. Therefore, just because it is your own branch in a different state, please do not use cross charge as a mechanism of transferring ITC from one state to another state. It is an offense under GST. So, multi-state registered taxpayers who have not taken ITC, ISD registration, they should take ISD registration. And most important, from now itself, please start informing your vendors to bill on ISD, get the credit in your GSTR 6A, and then route it through ISD registration. Some people make a mistake. Even blocked credit needs to be distributed, and then it needs to be reversed in the normal registration. Even credit notes raised on ISD, that needs to be distributed. Debit notes raised on ISD, that needs to be distributed. So whatever is appearing in your GSTR 6A, that needs to be distributed. Please do not only distribute the eligible ITC, right? And more so after this circular 170 and notification 14/2022. Everything which is appearing in your 2A may be blocked credit, it may be eligible credit, it may be credit note, it may be debit note. Everything needs to be distributed through GSTR 6 and through a ISD invoice. So this is with respect to a major change, and all businesses, they must review their ISD and implement this change immediately. So for manufacturers of pan parag, pan masala, tobacco, gutka, there was a new scheme wherein the machines which they use for manufacture of pan masala, gutka, tobacco, etc., they need to be registered in form SRM 1 along with a chartered engineer certificate in form SRN 3 on the GST portal, and a unique number would be generated. This notification would come into effect going forward. Once it comes into effect, and in case the manufacturers of such products, if you do not register your machines on the GST portal or do not within 30 days, or the new machines within, sorry, the first machine within 15 days, or subsequently within 7 days, or do not make the amendment in the made in the machines on the GST portal within 7 days through form SRM 1 and chartered engineer certificate in SRM 3, then other than the other penalties like common penalty, etc., you would be charged 1 lakh rupees, plus the machine would be liable to seizure and confiscation going forward under section 122 capital A of the CGST Act. So the manufacturers of pan masala, tobacco, gutka, etc., they would go into a completely new GST regime going forward, which has not been seen in the past 6 years. This regime may come into vogue for other sin products which are prone to evasion also going forward. So friends, these are the income tax and the GST amendments via the Finance Bill 2024. Two very important changes and procedures, one in income tax, one in GST, I would like to discuss over here. First, in income tax section 43B clause H. This needs to be implemented in February 2024 itself, so that you do not go through a hardship on 31st of March 2024 and income tax disallowances are not made. What is this? So first of all, as you already know, friends, the government is promoting MSMEs. In case you have an MSME vendor, that is a service provider or a manufacturer. If you have an MSME and if you are paying them interest on delayed payment, you all know it is disallowed under section 37 of the Income Tax Act. The tax auditor needs to report it. Now, from this financial year, applicable from assessment year 24-25 onwards, under 43B clause H, any payment which you are making to a small and micro enterprise, not medium scale enterprise, that is those enterprises which are service providers or manufacturers, not traders. If you are making them any payment and there is no agreement, if you are making them any payment after 15 days, or if you are making, if there is an agreement and if you are not paying as per agreement or maximum within 45 days, then if such a small and micro enterprise creditor is outstanding in your books on 31st of March 2024, then such expenditure would be disallowed for assessment year 24-25. It would be allowed in the subsequent assessment year when such expenditure payment is made, right? So what is a small and micro enterprise? They are enterprises, number one, and most important, if they are registered on the Uttam portal and you have a certificate and declaration that they are micro and small enterprise, or if they are service provided or manufacturers, not traders, and their turnover is below 5 crores or 50 crores for micro and small enterprises, or their investments in plant and equipment is less than 1 crore or 10 crore for micro and small enterprises. So let us understand with these 4 live examples. Say for example, first on your screen, you have a bill dated 1st of February 24, that is yesterday's bill. And the payment term says 60 days. But as per section 15 of the MSME Act, you have to pay maximum within 45 days. So effectively, as per MSME Act, your due date is 17th of March, 28 days. February is 28 days, right? But if you pay on 28th of March, you have made a delayed payment to the MSME, but luckily for you, you have made a payment before 31st of March. Therefore, you can take the deduction in the assessment year 25, 24, 25 itself. Clear? But same day bill, yesterday's 1st February bill, due date is 17th March, but you have paid on 15th of April. You have made a delayed payment of more than 45 days. After 45 days, and you have not paid within financial year 23-24 also. So the repercussion is you will not be allowed to take a deduction in assessment year 24-25. It would be added back and you can take a deduction only in assessment year 25-26, right? You might ask me a question that I have made a payment before filing my return. Can I still not take a deduction? Answer is no. Friends, a specific exception has been made for clause H. For all other clauses, you can take a deduction in case you have made a payment before filing of your annual of your ITR. But for 43B clause H, there is no such exception. There is an exception and there is no such relaxation. Clear? Now, you get a bill dated 20th of February 2024. So the due date is 5th of April, 45 days. You make a payment on 2nd of April. That is before 45 days and considering there is an agreement, right? So you have made the payment before due date or before 45 days, you can take the deduction in financial year 23-24. But same invoice 20th February, you have made the payment after 45 days, that is 10th of April. So that amount of the bill needs to be added back in your ITR, in your computation you are preparing for assessment year 24-25. And you can take the deduction in assessment year 25-26. So what are your points for action? First of all, make an agreement. It can be an email agreement with a small and micro scale enterprise. So your time period for making the payment is extended for 45 days until unless the agreement is for a lesser period of time. Otherwise, if you do not have an agreement, the time of making payment is only 15 days. Next, review your creditors, small and micro scale enterprise creditors before 31st of March. So that whatever payments are required to be done, you do it before 31st of March and there is no hardship. But do not only, you see, rely on vendor declaration. Do take the Udgam certificate from your small and micro vendors, right? And finally, make the payments as per the due dates. So this is a very important change in income tax, which needs to be implemented from today, from February 24 itself. Another important change in GST, although not in the law, but you would have all heard about the Madras High Court decision in the case of Aicha Motors, which is contradicts the decision of the other high courts. So on your screen, we have shared a small example. Say, for example, you are filing the GSTR 3B for the month of January. The due date is 20th of February. The GST payable is 10 lakh rupees. Your credit ledger balance is 8 lakh rupees on 31st of January or 20th of February. Your cash ledger balance is 2 lakh rupees. So your GST payable amount is covered with your credit ledger and cash ledger balance. You file your GSTR 3B on 25th of February. The question was whether the interest is applicable or to the extent of the credit ledger balances or not. That was already covered after an amendment was made to section 50 of the CGST Act with retrospective effect from 1st of July 2017. So no interest is applicable in case to the extent of credit balance in your credit ledger. So no interest to the extent of 8 lakhs in my example. However, across the country, the department was raising the demand on the late filing of the GST 3B return to the extent of balance available in the cash ledger and applying interest on that for the period of the delayed filing of the 3B. They were taking a view that the filing of the 3B is the final discharge of the GST liability as advocated under Rule 61 of the CGST rules. However, in the case of Eicher Motors, the Honorable Madras High Court has ruled that GSTR 3B is not a mechanism of payment of GST. It is a mere mechanism of set-off. While you are making the GSTR 3B return, the GST has already been paid earlier. Even Section 49, Explanation A, and Section 49(11) provide that when you are making a payment to your cash ledger or a deposit in your cash ledger, then the government already gets the credit of such payment. The GST collection figure, which we just saw day before yesterday, 1.66 or 1.7 lakh crores around, that includes the deposit of the electronic cash ledger balance. And if this GST collection figure was not allowed to take cash ledger balances, which means the government or the exchequer was not allowed to utilize the money available in the electronic cash ledger, it would be disastrous for the exchequer. Since the government utilizes the money in the electronic cash ledger balances, therefore, there is no loss to the government even if GSTR 3B is filed delayed. And therefore, to the extent of cash ledger balances also, the interest would not be applicable for delayed filing of GSTR 3B return. However, as I have mentioned earlier, the government may argue and the government may take it to the apex court via an SLP stating that the discharge of the GSTR liability is via GSTR 3B, although it is via a journal entry, you might say, but possibly there are some adjustment in the government books due to which they might be taking a view that to the extent of cash ledger balances, interest would be applicable. However, till such time that further high courts or the apex court in case appealed against rules in this favor, this decision in the case of Eicher Motors provides a much sought after relief, and many of the cases in this regard can be contested accordingly. So friends, thank you very much for joining and staying along on a working day. I would now take all the questions in the chat box. Okay, RST and company says for group companies only, option appears to be cross charge. We cannot use ISD for cross charging group companies. Of course, ISD, the group company is a distinct taxpayer. It is a different, it is not a distinct person. It is a distinct taxpayer itself, right? So for group companies, it is not cross charge. It is actually the provision of goods or services. Mr. Ashok Jha says there is no requirement of cross charge now and all input services will be distributed by ISD only. Please clarify. Yes. Now again, as I said, Mr. Jha, to the extent of the common input services, only ISD is the option, but for internally generated services like CFO services, no cross charge is required. Again, Mr. Jha says, can we get bills of advocate or RCM bills in ISD number directly and pay GST on RCM and distribute? Yeah, Mr. Jha. Now, again, as I explained, if you see section 2, subsection 61, it seems, yes, you can take an advocate's bill on ISD and pay and take the credit and distribute through ISD. But if you see 20, subsection 2, it is my view that there is a little conflict over there. If ISD needs to pay for RCM, take the credit, distribute it, then a significant change requires to be made in Rule 39 and on the GST portal. So let us wait going forward and see how the machinery would be built in, right? As it is, this amendment in the finance bill that would take 4 to 5 months after getting passed by 50% of the state legislatures, only then it would be implemented. Till such time, if ISD needs to pay on RCM, possibly the GST portal would also get equipped. As of now, there seems to be a conflict between 2 subsection 61 and 20 subsection 2 of the CGST Act as amended, proposed to be amended. Mr. Tarun Arora says if we are registered in multi-states, have RCM on import of service in one unit, we are not distributing input, still do we need ISD registration? Tarunji, see, if you are making a payment on RCM on import of services, which is only related to the GSTIN, in which you are making the payment of RCM, then no need of distribution. But generally what happens is that the RCM payment is for royalty. Royalty is for all the states, right? So in that case, you have to distribute it to the ISD registration. It is mandatory. Otherwise, your state in which you are taking the entire credit, they may dispute the ITC. Mr. Naveen Kumar says, can you clarify whether invoicing to be done for support services includes salary of common staff by HO to BOs through ISD? So as Mr. Kumar, as I said that there is no mandate after circular 199, it is clear for internally generated services, there is no mandate. But if you want, you have an option to do a cross charge. But your question is ISD. So, yeah, ISD you can do, in my opinion. So, from your normal GSTIN, you need to bill it to the ISD, and through ISD, you can distribute it. In my opinion, yes, it can be done. So, I think these are all the questions we have answered. Thank you very much, friends, for joining. We'll have again the webinar. Long time we have had our colloquium. Also, we'll have our colloquium very soon, possibly after the council meeting. Thank you very much for joining. Over to you, Samir and Artikli.
Thank you,
Samir,
Vivek.
over to you.
Thank you, Vivek. Thank you for taking us through all the changes in budget. Plus, other than that, whatever the recent important judgments and developments in GST. As you said, we will again join you with the next month colloquium after the GST Council meeting. Till then, we wish you a very happy day and a very happy weekend. So thank you, all of you, to joining us. With you, Titli, hand over to you. You can close the session.
Yes, sir. Thank you, sir. Thank you, sir. Thank you, Vivek, sir, for this wonderful deliberation. Thank you all the participants for attending the webinar. We conduct such webinars every month, and we hope we will get you in the upcoming webinars as well. We will shortly share PPT and video link to all the participants. Thank you.